Hey guys, good afternoon. I'm Mike McKearns with Aviante Staffing Software. Thanks for joining us today at this breakout session. It is best practices for buying a staffing company. Just a little bit about Aviante before I introduce our speakers here. Aviante is a staffing software provider that was founded back in 2005. We've grown a ton since then. We are now the largest staffing software provider in North America that's able to provide a complete end-to-end front and back office system to include ATS, CRM, billing, payroll, time entry, all in one platform. So, as I'm not sure if these guys are going to touch on it today, but technology plays a role at some level in the valuation of your organization. So I'll let them speak to this piece of it. But before I welcome our presenters, just a quick reminder that you can access the resources for this session and others by using the hidden resources on their website or by using the Staffing World app. Also, don't forget to rate the session. There's going to be a QR code towards the end of the session on one of these slides here. So without further ado, we've got Chad Gardner, Managing Director of Investment Banking with Bridgepoint Investment Banking. Michael Napolitano, partner with Citrin Cooperman. And Paul Pincus is a partner with Ortelli and Rosenstadt. So thanks all. Please don't forget to rate the session at the end and enjoy the session. Thanks a lot.
Thanks a lot. Welcome, everyone. Thank you for joining us today. We're going to be talking about the state of the M&A market and our thoughts for what 2025 will look like and trends that we've been seeing in the M&A market from the buyer's perspective. Just a little bit of further background. I'm a partner at the Ortelli Rosenstadt law firm, where I head up the firm's mergers and acquisitions and staffing practices. To my left is Michael Napolitano, a partner at the Citrin Cooperman accounting firm and co-practice leader of Citrin Cooperman's staffing practice. And to my far left is Chad Gardner, a managing director at the Bridgepoint Investment Banking firm and head of the firm's business services group. So you've got an experienced panel with you today to share their thoughts with you on what we've seen and what we think will be coming down the pike as we move forward into next year. I would ask you to please write down any questions that you have and hold them for the end. We're going to try to leave 10 to 15 minutes at the end for everyone's questions. So with that, Chad, can you kick things off by giving us an overview of the current staffing M&A market and your thoughts about what 2025 will look like?
Sure. Last year there was about 175 staffing transactions in North America. This year to date, there's been just over 100 staffing transactions. We saw a little bit of a decrease in healthcare and IT M&A activity. Most of the transactions are smaller deals, companies with 25 million or less. I would say, the market is not that great right now, with a few exceptions. But overall, the market is down, and buyers are opportunistic. I would certainly categorize it as a buyer's market right now. The transactions I've seen getting done are usually at terms that are more favorable to buyers, with a few exceptions. The exceptions I'll point out that are still trading at attractive multiples and getting a lot of attention. Locum tenens is a market that's got a lot of attention. Those deals are trading at double-digit EBITDA multiples. I'd say that some IT staffing that are higher on the value capital stack, higher value add or niche, are getting outsized attention. And then in the skilled trade staffing is also getting a lot of attention. But the rest of the market is down, and buyers are not keen to break out their checkbook when they see a business that is down year over year, which makes it tougher to see deals get done. Now, in terms of my crystal ball for next year, which is always 100% accurate, right? I don't think the market's going to change all that much in the first half of this next year. You know, I still have a question mark about the second half of next year, right? As interest rates are coming down, and you know, there's the market's projected to improve next year. We'll see a slight to, you know, a little bit of growth. You know, as the predictability of the staffing space, you know, as there's more visibility on the predictability of projections in the staffing space, and as interest rates drop, at some point, I do think we'll see buyer appetite increase as they're comfortable underwriting a stable business. You know, when would that be? I don't know, but you know, at some point, we should see buyer activity pick up. I'm not exactly sure when that'll be.
So who are the most active buyers in this market? Is it strategics? Is it private equity? What are you seeing?
It's definitely strategics that are opportunistically picking up deals at a price at which they're happy to pay, meaning they have most of the negotiating leverage. So I think strategics are being opportunistic and they're picking up small tuck-in deals. I think that's most of the activity right now.
So my understanding is that private equity has continued to be involved in smaller deals. Is that what you're seeing as well?
Yes, and they're you know, picking up smaller strategic tuck-ins at deal values that they're happy to pay, which means, you know, that are attractive to the buyer.
Gotcha. So speaking of private equity, you know, what is the state of the financing market, and how is that impacting M&A? Because we've seen that lending rates have obviously gone up for private equity. Lending, you know, the ratios at which institutional lenders have been willing to lend to private equity have come down in recent years. You know, all of which, you know, has negatively impacted private equity's interest in doing larger deals. But you know, what are you seeing?
Well, all the cheap money from commercial banks that we had in 2001 is gone. A lot of the commercial banks are not very aggressive, you know, outside of, you know, typically what they do in ABL. What we've seen is the evolution of the private credit market. And for staffing businesses that are, you know, skilled staffing, the private credit market is there and available. You know, it's more expensive capital than commercial bank debt. And so, you know, people are being judicious with whenever they borrow this more expensive capital. It's got to be a highly strategic acquisition. So if you're buying EBITDA or you're buying out a shareholder or equity, the math still works. But you know, you're taking on much greater risk because you're not borrowing against that cheap bank debt. So.
Not sure. All right, let me talk a moment about what we've been seeing in valuations and deal terms, you know, as far as cash versus earnouts. You know, we've been seeing, and you know, both of you guys feel free to add your 2 cents, is a segmented market. Unlike in 2021, when we were coming out of COVID, and there was a bit of a feeding frenzy, and you know, we were all saying how the rising tide was kind of lifting all the boats, and there was demand for all businesses, and valuations were driven up for all businesses across the board. That's not happening now, and frankly, wasn't happening last year either. So, you know, what we're seeing is, I guess, kind of 3 tiers in the market. The tier number 1, and Chad can talk in more detail, you know, once I finish about, you know, what he considers a tier 1 company. But those companies are the ones that are in the most demand and short supply. You know, they're typically the big, highly profitable companies that are, you know, the leaders, you know, in their segments. Those companies are in high demand, and there's plenty of buyer interest for them. They are getting valuations comparable to the peak of 2021, sometimes even above that, primarily based on scarcity and demand. And those deals, we're typically seeing all cash deals or 90% cash at close and a 1-year earnout. Then dropping down to the middle category, companies that are average to above average, we're seeing good valuations and good interest for those companies. Valuations, I would say, comparable to what they were in the healthy markets of 2018 and 2019, although the buyer interest is somewhat lower than it was in 2021 when all buyers were afraid of missing out on the next deal. And those deals, we're typically seeing 70 to 80% cash at closing and 1 to 2 year earnouts. Then the bottom category are businesses that are below average. Obviously, no one here has a below average business, but those businesses are tough to sell. There's very little buyer interest for them. The deals that are getting done, are at long earnouts, typically 2 to 3 year earnouts, 50% or less cash at front, up to maybe 70% cash up front, and at prices that sellers are generally not crazy about. Those are tough deals to do at good prices. Chad?
Yeah, I like to quantify an A asset, right? Because everybody says my business is an A asset, right? So what does that mean? I would some metrics I would point to from private equity and institutionals' perspective on what qualifies as an A asset. I would say 80 million of revenue or more, growing year over year at 15% or more, gross profit margins of 25% or more. Like, just to kind of quantify what an A asset looks like, right? Those are probably some of the metrics I would throw out there, right? And look, at most of the market is down. They're not growing 15% year over year. So that is what would make a business stand out to investors. Everybody wants to buy a business that's growing, not one that's shrinking. And the visibility of that growth will get investors comfortable, more excited to break out their checkbook.
Okay. Chad, you're seeing the same kind of segmented market that we are?
Absolutely. So the segments that I think are most active are locums is very active, skilled trades, and some niche IT staffing is where I'm seeing most activity.
Okay.
Where premiums are still attractive.
Right, but you're also seeing the same kind of 3 categories in terms of companies that are getting premium valuations, companies in the middle, and then companies that that are below average.
Sure, I would describe it as very sellable, sellable with difficulty, and unsellable.
I like that. Michael, so what are your thoughts about what we're seeing and what you think 2025 looks like?
So I think I'm in a different position as the accountant for most of you. So I'm more of a psychologist than an accountant, because the whole process as the business owner, the first thing I have to tell you is values have dropped. And one of the biggest obstacles for my clients when selling is the economic reality. We're not where we were in 21, 22. Now, Chad mentioned an A client. So I laugh because I'm thinking of all my clients who has 25% gross margin, growing 80 million and growing at 15% a year.
Yeah.
So my clients who are in LI, it's been a really, really tough year. My clients are down 10 to 30%. Healthcare down, pressure on bill rates. Even on professional services, it's been a tough year. Probably of our 200 plus staffing clients, I would say 60% are down. So for me, a good year is flat. If you were flat in 2024, you guys are in good shape. And think of us as the first time when you're thinking of going to market, I'm the first person who's going to tell you your company isn't that great, right? It's the first time someone's going to look at your company and say, all right, you're not that great. Here's all the reasons why. So in a market where values are down, how do you separate yourself? How do you create that light industrial 4 multiple? Maybe 2 years ago I could get you 5, you're a 4, so how do you get a 4.25? So what I always say is selling your business is like brain surgery. Your professionals can get you a couple $100,000 or millions more. If your company is set up correctly, if you have the right professionals, your investment banker is a tremendous resource. I'll argue your accountant, of course, is the most important, and your attorney protects everything. But how do you get the value there? So typically my speech is you need to prepare 2 or 3 years to sell your company, which is true and accurate. I will tell you 60% of my deals with clients over the last couple of years are, I was here, I met someone, I have an opportunity to sell my company. So the reality is most people say, I'm going to set up, plan for a sale, but the opportunity usually arises where you had no chance to plan, right? And we're going to get into some of the details on how you can help create that value. The other side of it is, if you're even considering it, most of my smaller staffing firms, we never do projections, right? We never look forward. All I can say is when you're selling your company, I'm not buying yesterday's revenues. I'm buying tomorrow's revenues and income, right? So you need to set yourself up for tomorrow. So a big component is, what are you doing if your business is down and I'm looking at you, what are you doing differently for tomorrow to turn things around? If I'm buying you and I see you're doing the same old thing, your multiples are going to be depressed. So you have to make sure your professionals, the Chads of the world, the accountant, the attorney, the Pauls of the world, are setting you up for that story on why you should get that better multiple. Because in this market, our clients are acquiring for growth. Organic growth is shot, right? So a lot of my clients are now buying as part of their growth strategy. And that's a recommendation I would have for everyone. You should be looking at M&A as part of your growth strategy in this market. And the final thing I'll say is this year has been choppy. My clients will call me up. I had a great head count in May, and holy crap, June, what the hell happened? Like, it's start, stop, start, stop. So, and I can't predict 2025. I really don't know where we're going. We're going to watch the fourth quarter closely on how does that compare to last year. So it's really setting you up for tomorrow. And the final thing I'll say is you can't let the business run you. You have to run the business. And that's how you're going to create the value.
Okay. Michael, what are buyers' key considerations? Chad, what are buyers' key considerations when looking at staffing firms to acquire?
Well, they're looking for growth, right? And growth and the ability to maintain margin, right? Back to what Michael was saying on creating projections for the first time, you don't want to figure out that you're bad at creating projections during the process, right? It'd be better to figure out that, to learn your business and understand how to make projections and hit projections before you're in the process. Because if you present a buyer with projections and then during the process you miss those projections every month, then the buyer's not even going to believe your projections, right? And they're going to discount you because they're going to feel like you have your grasp of the business is not as solid as you're presenting. So, a lot of times people will make projections based on hope, maybe not on reality. And as a way to present that your firm understanding of your own business, learn how to make projections based on reality, and that will instill confidence in the buyer in understanding your business and understanding the levers of your business, what's driving the business, and they'll feel more comfortable underwriting what you're projecting, because they'll feel like, okay, this person really understands their business, the levers of their business, how the business is going to perform. It's not just pie in the sky. And so buyers want to understand, what is the base level, what is the visibility of the business, what is sort of the base level of how the business is performing today, how is that business growing, are the growth initiatives working, or are they just big ideas, right? My growth ideas are to do all this stuff that I haven't even started, right? They're not going to give you any credit for that. So growth initiatives, how those are performing, how those are being realized, is it working? Are you going into a new vertical? Are you going into a new staffing line? Is it working? Are you cross-selling into your existing customer base? Are you getting more wallet share? Have you address any customer concentration? Is that concentration diminishing over time as you win new business? I mean, the best way to address customer concentration is to get another big customer, right? And so just your understanding of the business and confidence in the business and understanding that helps buyers feel comfortable with what they're underwriting, because we're asking them to break out their checkbook and write a big check.
Customer concentration, what percentage?
How about less than 15% for one customer? And just so you know, there are private equity funds that in their agreements with their LPs, they will say, we will not buy a business with more than 20% customer concentration. So there's a whole buyer's universe out there that just can invest in your business if you have customer concentration by their agreement with their limited partners.
Michael, what are you seeing from the accounting side in terms of what buyers focus on?
So just to add on what Chad's saying, the worst thing you can go through is what I call a slow roll. So what we've seen buyers doing is slow down to see the next month's results. So we've had a number of deals where the buyers have been dragging the closing because every month we're deteriorating. And what do you think that does to purchase price? So timing is everything, and projections. So that is a big part of what every buyer is looking for. Again, you're buying tomorrow's revenues, you're not buying yesterday's. And what a lot of companies fail to do is tie those projections into current performance. So headcount is dropping, but you're projecting increases. So you need to just have some common sense eyes looking at how are you arriving at those projections. And of course we want them to be rosy and optimistic, but you have to have some sort of support for that.
By the way, what time frame do buyers typically look at? Is it the next 1 to 2 years, next 1 to 5 years? What are you typically seeing?
All right, so buyers matter. You have experienced buyers that come in with an experienced group. They're looking at 5 years. Some still want to see pre-COVID and during COVID and post-COVID. A lot of the smaller deals, they're looking at more 36 months. Okay. But most people we're always looking at 5 years, but you're going to need 5 years balance sheets, P&Ls, headcounts as well. They want to see top 10 customers, gross margin by customer, headcount by customer. So there's certain information you need to have ready. And what makes a buyer nervous is the longer it takes you to present information they're requesting, the more nervous they get that you don't have an accurate accounting, that your systems are not in place. So the preparation for the sale is extremely important. And you have to have monthly financials. You have to be accrual basis. There are little things that for when we're onboarding new clients, they're still on cash basis. They're using QuickBooks. Nothing against QuickBooks. Yes, Aviante is 10 times better. Give you that plug. But you have to have some of the minimum basic financials. We've onboarded a number of staffing firms where their P&L is wrong. It's not listing their sales direct cost to get a gross margin. So I know if we have a light industrial firm, your gross margin's 13%, you got a problem, right? Most of ours are in that 15 to 17%. So why is your gross margin so low? Well, maybe it's due to your underlying customers. There's a reason for that. The market's competitive. But we have to have a story. You have to understand your performance. So we've had a number, Paul, where we've done just revenue analysis. Our clients, Chad and I worked on a deal. It was a large healthcare staffing firm that our client was purchasing. Our sole focus were revenues. There was issues with VMS, billing wasn't done on time. So we literally, you don't want to use the word audit, but we did a review of their revenues. So every deal is different. What is important for you? Are you trying to get in a new market? So a lot of our clients want to get out. I'm in New Jersey. I don't know if any of you operate in New Jersey, but we've had a lot of bad regulatory laws, temporary Bill of Rights that I'm dealing with. I'm on the board of the New Jersey Staffing Association. I live through it. So a lot of my light industrial want to get out of New Jersey. So we're buying geographically. We want to get out. So what is your plan? Don't buy just for the sake of buying. And finally, integration we'll talk about. Everyone wants to buy. You get to the finish line, and then the integration is awful.
Okay. So, what are buyers looking for? What's from the legal side? The answer is pretty simple. They want clean businesses. Okay, buyers don't want problems, and they don't want surprises. We're on the buy side probably 60% of the time, and I will tell you that when we start doing some preliminary diligence and we see lots and lots of legal non-compliance, I immediately have a conversation with my client. I think we should consider passing on this business and looking for another. That's why those of you who are sellers in this room, it really is incumbent on you, as Michael was saying, from the accounting side, to basically clean up your business. Bring in a professional a year or so in advance of going to market to review your business, get your legal house in order, get your policies, forms legally compliant, settle any litigation that can be settled at a reasonable cost, because it's going to be difficult to sell your business if it is not legally compliant.
And I'll just add one thing, if anyone's familiar with add backs. So when you're selling your business, you have your reported income and then add backs, personal expenses, family members on payroll, you name it. I don't work for the IRS, put it out there, but you need to have your add backs. And if you have 50% or more of your value are in add backs, it's going to be a problem. They're going to be scrutinized. 2 years ago, the market was so different where the due diligence was real quick, looks good, let it rip. Now, there's much more scrutiny on not only the financials, but all the add backs. So if you are thinking of selling, just use common sense on what's going through the business, because that's going to be a key part of what's going to be analyzed.
Yeah, let me give you a worst case scenario, since I have lots of experiences of worst case scenarios. Imagine trying to dig through add backs by looking through your credit card statements to figure out which expenses are personal and which ones are business related. And while the buyer's sitting there waiting to hear back what the adjusted EBITDA is, you're trying to go through all your credit card statements to judge which ones are personal expenses or not. Like, that's a terrible situation to be in.
Yep.
So make sure and track what's personal and what's business related.
Yeah, I mean, just a quick side story. Michael and I worked on a deal together about a year or so ago. We were on the buy side, and the seller's profit consisted more than 50% of add backs, and we wound up, my client and I wound up walking away from the deal because basically we felt the financials were unreliable. So that's just something to be mindful of. What buyers are looking at, and Michael and Chad are saying, when you're running your business, it might work okay for you now to put a lot of expenses through the business, but when it comes time to sell your business, it's not so helpful. When a buyer looks at an unusually high amount of add backs as a percentage of the business's profit.
And by the way, they want add backs by month. You know what a pain in the ass that is to go through your credit card every month?
Yeah.
To do it, because they want monthly financials. And finally, your financials it's a story. What is that story telling a buyer? And they want a 3 to 5 year story of your financials, but then they want you to add to that story with projections. I mean, that's the key thing with your financials.
Okay. Michael, let's start with you on the next topic. What have you seen as challenges to getting deals done in this market?
So, financials. Probably the biggest roadblock are getting the complete and accurate financials. The ability for the seller to have the information at their fingertip has really become a sore spot. So if you are selling, spend the time with your professional to get the financials. But make sure you're talking to a professional who really sets you up on what you need to provide so it's ready. Because when Chad comes in and says, I need, the trailing 12 months, because now we're in October, you got to do the period November 1st to October 31st. Then you got to do the trailing through November. And most clients are not doing quarterly adjustments to their books and records for the proper accruals. The other big thing are accruals. So your accrued paid time off, your accrued commissions, any of your taxes. And that's another one I didn't even talk about, the due diligence on your tax compliance. That is an easy way to get a reduction in purchase price or money in escrow. So it's understanding where are the services being performed, who are your customers, where are they located, determines, it's a cost of performance market approach. Also sales and use tax. You know, Pennsylvania is a great example that has sales and use tax. How many clients are not familiar with that? New Mexico is another state. So these are easy ways for buyers to either get money set aside in escrow. What does that mean? Well, you got to wait for the 3-year period, the look-back period, so that money sits in escrow for 3 years. Or more, you're seeing a reduction of the sale price. So tax compliance. And it's actually real simple if you're thinking of selling, is bring in a third party who looks at you with clear vision. We're going to talk about equality of earnings, but have someone come in because you need to know that before you go to for sale. So what are all of those potential landmines that may be there that can be identified, addressed, and a story can be prepared, or we can prepare and say next year we're going to do things differently. But preparation, so you all know how you run your books and records. I don't think there's any secret. All of you know what you're putting through, how accurate are they. Be honest, make that assessment, and bring in the right professional to help you.
Okay. Any other key issues? What are you seeing, for example, in terms of valuations? Are you seeing that as a challenge to getting deals done?
Valuations are a big challenge because that's the first question I get. What am I worth? What can I sell for? And what's great with a group like us is you pick the industry. I'll give you a range of where I think you'll sell. And healthcare is a great example. A client of mine could have went to market 2 years ago to get an 8 or 9 multiple. He's selling for a 6. So that's market. It's nothing he did. He does have a little concentration, which dinged him a little bit. The concentration is a big part of it because a lot of my clients lose sight about how they have a concentration. Until you're actually looking at the data, you're looking at gross margin by customer. But that's what we're seeing. It's a lot of it is financial based and understanding it.
Chad, what are you seeing as challenges?
The biggest challenge is if a business is down year over year, the buyers are saying, well, where is this business bottoming out, right? And to say we have 3 months of flat business doesn't instill a lot of confidence in a buyer, right? I mean, they want more than 3 months to prove that there's an actual trend. So I think the part that's most businesses are struggling with is being down year over year, and buyers looking at it and say, well, where's this business bottoming out? And do I have enough data, trend line data, to feel comfortable that it has bottomed out and we're going to continue to grow? If they're breaking out their checkbook, they don't want to be wrong, right? And if you're a private equity party and you overpay for a business, you're not going to be invited to the next fund, right? So they're betting their career and they don't want to write a bad check, and so having enough trend data to show consistent, predictable growth is a lot easier than trying to sell businesses down year over year.
And the last thing, small deals are harder than big deals. Working with my clients that are looking to acquire as part of their growth, the biggest hurdle we have with the seller is not only value, but they have the wrong professionals. So in trying to get some basics down, it's very difficult. So small deals are hard. By the way, everyone's looking for a small deal. I get calls daily from other industry partners saying, hey, do you have anyone interested in selling? But small deals are very difficult because most sellers are thinking their values are what they were 2 years ago. And so all my clients say, I'm going to protect me because I need to have that relationship. Can you get on the phone with their professional and tell them why their business is worth 30% less? So that's a big hurdle.
Yeah, I can attest to that as well, which is why we try not to do small deals. They're much more difficult to close. The sellers tend to be less sophisticated, as you say. They tend not to have the best professionals, so their accounting records, are not, on accrual basis, and they tend more often than not to be not as reliable as a larger company. The businesses tend to not be as legally compliant because they don't spend the money, on a more capable law firm, and it's, there's just more problems in small deals, which is why I recommend to our buy-side clients to look for businesses at least 20 million in revenue. That seems to be, about the point, and it's not a hard number, but there's enough critical mass. You have less, you don't have as much customer concentration as in a smaller business. You tend to see better financials, better legal compliance. The owners, a bit more experienced and sophisticated. So, just for those of you on the buy side, looking, yeah, you might be able to get, a bargain, buying 5-10 million in revenue, but understand that, that business is probably not going to be as good quality a business as something a little bit larger, and the risk of that deal closing, are lower than if you were to do a somewhat larger deal.
And there's those smaller businesses tend to have a lot of customer concentration, or at least that's what I see a lot of the smaller deals.
As I mentioned.
And if they're running their business on Excel spreadsheet, then there's a lot of risk with that too.
All right, Michael. So you mentioned due diligence earlier. So what are you currently focusing on in your financial due diligence on deals?
So the process is definitely longer than it was. Buyers are spending much more time on the customers. They want to know your customer, the history of that customer, headcount by customer, what industry that customer's in. So they're really drilling down into your customers. More so on the financials is just spending the time, are they correctly reported? Are you accurately reporting your financials? Is your EBITDA what you say your EBITDA is, and add backs? What we're seeing is a lot of stretches on add backs. When I see a $300 add back, I'm like, I can't believe you wasted your time for a $300 add back on a sheet. So I would say the concentration is on revenues and compliance. Compliance is becoming a big part of it. I don't know if we're going to get into details on an asset purchase versus stock, but if I'm buying Paul's company and I'm buying the stock, it's as if I own the company from day one. So I'm inheriting any potential skeletons from Paul. Now, Paul will do great on the legal language to make sure we're protected, but the tax compliance, the DOL compliance, little things we've seen. I'll give you a real example. A client of mine purchased a company in Wisconsin, and areas you don't think about, but payroll taxes, right? You buy them, they're on their own payroll. We onboard them, and my client calls me up, holy crap, they were missing a 3% surcharge that they were never paying incorrectly. So that's a 3% cost that we didn't anticipate. Had we known that, we would have recasted their EBITDA to take into account that cost that they were not reporting. So again, working with the right professionals helps you mitigate some of that risk as much as we can. So again, compliance, and it's the financials, and it's really projections. That's your key. You have to have the projections to give me the comfort I'm buying those revenues. I think I am.
I'll tell you a quick horror story in compliance, if I have 1 minute. So I was selling a travel nursing business last year, and the buyer was taking a look at the documentation that's required for a travel nurse in order to qualify for the stipend, for the a portion of their expenses being reimbursed. And the risk is if the IRS does a payroll tax audit and decides that that stipend is really not expense reimbursement, it's really comp, and then that company now owes payroll taxes on all that stipend money. And so the buyer did essentially an audit of the documentation for that compliance and said, we don't like what we see. We're only interested in moving forward if it's an asset deal, which means the seller is retaining that payroll tax audit liability. So we ended up closing the deal, and we structured it as an asset purchase, and we went to Aon and got a insurance policy to just underwrite for the potential risk of a payroll tax audit. So the seller was able to sell. It was an asset deal, which took an extra month to close. It's not as fast. But then the seller got a specialized insurance policy to cover that potential risk.
Okay.
And fun fact, with payroll reclassification, clients will say, all right, FICA, Medicare, 15.3%, right? Double FICA, double Medicare. But they also hit you with federal withholding because there was never reported as income by the employee, so they'll assess a 25% withholding on top of that. So it's a big hit if you get a reclassification to payroll taxes.
And if you want some more horror stories on that, I can tell you afterwards.
Okay, so let me tell you what we're focusing on from legal due diligence. First is what you guys mentioned, sustainability of business from existing customers. Second, something that has been in the forefront of news recently, the ERC. It is something that most staffing firms have applied for. While I certainly don't believe anyone in this room would have submitted a fraudulent application, the rules for qualification have had gray areas to them, and many of the applications that have been filed, while not fraudulent, have not been sustainable. We're going through that on a deal we're working on right now. And we had to create a special escrow, or on the buy side of this deal, and we required the special escrow from the seller to address that multi-million-dollar liability. Other things that we're focusing on, you guys mentioned misclassification. That's a huge problem and an ongoing problem, particularly in the professional sectors, such as IT staffing. Both in terms of overtime and whether an independent contractor versus employee status.
Yeah, I'd say that the 1099 versus W-2 can be a deal killer if it's not done correctly.
That is correct. That's one of those red flag areas that we focus on in due diligence. Cybersecurity, which has become an increasing issue across all industries. Restrictive covenants. As everyone in this room probably knows, legislatures in many states across the country, as well as courts, have been increasingly hostile to restrictive covenants in recent years. There are things that sellers can do to make them more enforceable versus less enforceable, but to the extent that there are enforceable non-competes in place, or enforceable to the extent legally possible. That's something that is a plus in selling your business, and something that will give a buyer comfort that once the deal closes, key employees are not going to walk out the door with business. And then, something that the last point, something which Michael focused on earlier, state and local taxes, which has been an increasing issue since COVID, particularly in the professional sectors where you have people working remotely, and the rules about attribution of income to a particular state are not complied with to the extent that they should be.
And just the real world, when do you tell your employees you're selling? What's your answer?
When the definitive agreement is all done and ready to sign the next day.
So this is the question I get all the time. When do you tell? When do I actually break it to my team I'm selling? And I don't know, Paul, you're, as the attorney.
Close to what Chad said, but I would probably break that out into different categories. There are certain key people in your business, your chief financial officer, your chief operating officer, who you have to bring in on what's going on really when you go to market, because they're going to be indispensable in providing the information that the investment banker is going to need in order to prepare a data room in order to market the company. And those people are also going to be indispensable from the buyer's perspective. And we frequently see as closing conditions that certain specified key employees will agree, to sign employment agreements and stay on once the deal closes. Rank and file employees, maybe that's within a week of closing, but clearly once all of the legal deal terms have been agreed on and there's really, no longer any substantial risk of the deal not closing. And then, temporary employees, day the deal closes. So, yeah, that's kind of, the advice that I give.
When somebody's buying a business, they're not just buying the horse, they're buying the jockey. So they having a deep management team that's involved in the business. I see a lot of business owners will maybe incentivize the management team with some sort of transaction bonus, have them involved. I mean, having a deep, strong management team does add value to the business and will make it more attractive to buyers.
Yeah, that's an interesting point that you make, Chad. That's, I mentioned about doing a legal audit of your business a year or more before going to market. And one of the things that I tell sellers is that you should put in place management retention / change of control agreements. If you haven't already done so, and truthfully, you should have already done so, because those agreements serve multiple purposes. One of which is to incentivize those key people to build your business over a period of years. So, putting an agreement like that in place, as you're about to go to market or even a year before going to market, you've lost a lot of that incentivization already by waiting. But so the best way to structure those kind of agreements is really for there to be a payment at closing that will reward those key employees for having built the business over time and staying with the business through closing. But my advice typically is that should be half of the total value that you want to give to a particular key employee. The other half of that value should be for staying on with after the sale for a period of a year or so. And that's critical. The buyer doesn't just want your key employees to be there and then leave once the deal closes. That the buyer wants those key employees to stay on and grow the business. So you want to incentivize the growth through closing and then a growth for a period of time afterwards. And that's also critically important to a seller that has typically a 1 or 2 year earnout. You don't, to me, it's kind of short-sighted to pay somebody, the total amount of a change of control payment, and then they leave, and the likelihood of an owner receiving its earnout, becomes substantially a risk. So I'm a big believer in management retention agreements.
I'll just bring up one other tool that I've seen very successful, Phantom Stock. I don't know if you're all familiar with Phantom Stock. One of the big questions I get is we have top recruiters, how do I secure them? And most of these young recruiters don't understand ownership. They don't want to deal with ownership. They don't want to deal with a K-1, all that fun stuff. So Phantom Stock has been a great tool where essentially you're assuring, Chad, if I sell the company, part of that value you help create, you're going to get a piece of it, but they have no ownership. And that Phantom Stock, I've seen a number of clients who, some clients short-sighted, I don't want to share a couple $1 million with XYZ employee. I get it, but that employee helped grow this company and build it, so you're getting X million more. So I'm a big proponent of Phantom Stock. If you have the key employees and you want to retain them, it's a great tool.
All right, I think we're about 10 minutes before the end, so rather than jumping into another topic, if there are questions, we're happy to open it up for questions. Hi.
For the tier 1 companies that you talked about, what are the multiples on those kind of businesses?
Chad?
Well, I'd say I'd probably say high single digit, but remember, we're talking about businesses that have both size, that are growing, and are sizable, right? Which is hard to do. It's easy to grow when you're small. It's hard to grow when you're bigger. And I know you're in the cannabis space, which is a little bit different. But I would say, in general, there is a correlation between the weighted average bill rate of the business and valuation, right? The higher the weighted average bill rate, the higher the skill you're staffing, the more specialty. So there's a direct correlation between, skilled staffing, unskilled staffing, and the weighted average bill rate in terms of valuation.
Now everyone here thinks I'm a stoner.
You got a niche?
High single digits on EBITDA?
Yeah.
Yeah, and certainly multiples, will vary depending on the sector that you're in. Premium multiples are, in IT services, particularly, solutions businesses, healthcare staffing, tends to command higher multiples. On the other hand, light industrial staffing, you often will see multiples 3 to 5 times trailing 12 months EBITDA. It is very much sector dependent, even if you're a tier 1 asset.
Yeah.
Yes.
So I've got two questions. One's real simple. So you kept saying small deals earlier.
Yep.
Is a small deal, I think I heard, is that definition 20 million in revenue and less? I mean, like if you just had a cut line.
Okay. So let me just ask you a follow-up question. What context are you asking that question in?
Basically company size, revenue size.
Well, look, what's a small deal is obviously relative, depending on who you ask. But yeah, I mean, I personally think a deal under 20 million in value is small. But in terms of what Chad was talking about, which we didn't have time for, unfortunately, I was going to talk about, assets versus stock. But, that's kind of, where I think the cutoff is in terms of where I would consider doing a stock deal, a business above, 20 million in revenue, for example. Below that, I think there's just too much risk. But once you start getting above 20 million in revenue, I think the businesses tend to be more legally compliant. The financials tend to be better, and you have to do due diligence. And if the business looks clean, then maybe it's worth doing a stock deal because. But one of the things that we didn't have time to talk about, but a trend that we have been seeing in this market recently is to do more asset deals, even on larger transactions, just because of the concerns about things like ERTC and misclassification and state and local taxes. So, yeah, we're seeing deals, that would have otherwise, in say, 30 or maybe even 40 million in revenue, we might have otherwise considered doing a stock deal because it's just easier to do a stock deal. You don't have to get as many consents, in order to do the deal. You don't have to onboard all the employees, all the licenses stay in place when you do a stock deal. But so buyers historically have preferred to do stock deals on larger transactions based on the simplicity of getting the deals done. But we're seeing, that needle move a bit recently toward more asset deals, even on deals the size of which historically a buyer might have wanted to do a stock deal. And the critical point that we've been seeing on the buy side is, is it too difficult administratively to do an asset deal? That's kind of become the critical question now. The default is, let's think asset deal first, not stock deal first. And can we do this 30, 40, 50 million of revenue as an asset deal? Are the consents manageable? Can we handle onboarding with hundreds or a few thousand workers? If the answer is yes, then that's what our buy side clients have been leaning toward versus doing the simplicity of a stock deal.
And I'll just jump in. Our clients that are serial purchasers, a small deal to them is under 10 million. Pretty much so, it's under deal value, so we're spending less than 10 million on that purchase price.
Okay.
Yeah.
Thank you.
Now, we're seeing a lot of $1 to $5 million deals. So we've seen a big uptick in the smaller deals. So you're talking about, $8 to $12 million in revenue companies.
So when you're looking at those smaller, typically tuck-ins, right? Are you finding like a certain percentage range of, during due diligence, of costs that you're able to synergize, remove?
Every deal's different.
Is it really that different?
Yeah, it depends on the seller. If the more put together the seller is, the more manageable the fees. We try to be very efficient in our due diligence, focus on the revenues, focus on the liabilities, because a lot of these small staffing firms do not have accurate books and records. So that's where you get caught in weeds. And we try to be practical with our clients and say, here's your exposure. It's a $2 million deal. Does it matter if it's 1.8 or 2 million?
Yeah, and I'd say in the larger deal space, there's a number of private equity owned businesses that are in discussions with other private equity owned businesses, and they're talking about a merger of equals. It's a way to create value, combining two businesses together without having to break out their checkbook. And so, the synergies they're looking at, apart from just figuring out the org chart, is, can we put together a pool of A and B recruiters and then maybe let go some of the C recruiters out of each pool? Who has investments in technology in their ATS and how they're, who has better investments in technology, and can the combined firm, can we come out stronger? So there's some discussions I'm aware of that are going on right now in that space of private equity firms talking about merging. I don't know if they'll pull the trigger. There's a million reasons why those kind of deals fall apart, but there are people talking about those.
Yes.
Do you guys see much of a premium being added for investments in technology, having a modern tech stack, having a deep leadership team, management systems, just like an overall well-run business? How much of a premium do you see there?
100%. So, especially from the private equity community, right? Because they're going to value all those investments that you've made in systems and processes, the availability you have of data. Everybody wants to know, what is the weighted average bill rate by client, the margin by client, by type of position being staffed, going back as far as you can. And having all those systems in place means that they can then plug in and do other tuck-ins to a platform that already has all those streamlined systems and processes in place. And hopefully, what the data would indicate, that as your recruiter to placement ratio is improving over time, as you have systems and processes that are adding efficiency at the recruiter level. So whether that's AI or whatever else is the buzzword is nowadays, to the extent that there's efficiencies added to your business and that we can demonstrate that over time, viewing you as a platform makes that much more exciting and easier business to sell.
Yeah, I'd chime in to say that businesses that invest in technology tend to be more efficiently run and more profitable. So, buyers are not buying the technology as such. What they're buying is a profitable revenue stream. So, because what's going to happen, frankly, is a buyer, which is larger, than the seller, has its own tech stack in place, and it's going to use its tech stack on the seller's business, pretty much regardless of whatever the seller was using before. So, it's not so. It's really a means of of producing better numbers to sell your business based on. Yes.
You mentioned a travel nurse company. How are relationships with VMS factored in valuation? So if there's a concentration and you're with 10 different VMSs, but you're placing through the IAS, AMNs, cross country,
Chad,
how does that affect valuation?
Chad, you want to chime in there?
Yeah, the short answer is negatively. Generally, buyers are looking for more direct relationships. or that you're placing through vendor-neutral systems. If you are working through an MSP, are you a tier 1 vendor? Like, how important are you to that vendor? The challenge with placing through MSPs is that they can slash the bill rate at any time, and you have no say in the matter. And they're trying to place the best and most profitable positions themselves instead of working through, their subcontractors or they're supporting the agencies that help them support. So it's tough. And I'm in discussion with a couple of private equity firms that are talking about merging because then they have more negotiating leverage with those MSPs as a tier 1 vendor, right? Because they're going to be placing more volume, and so they'll be more important to that MSP and have a little bit more negotiating leverage.
Okay, I think we've run out of time. Thank you all for coming today.
Thank you.
We'll hang around for a couple minutes if you have any more questions.
Thanks, everyone.